All right. Thank you, Alison, so much for joining us again for this supplementary session we're doing after our webinar that we hosted together on tax season. We're really excited to chat a bit more because we had seen so many questions not only during the session, but people sent them in ahead of time as well. And so we're really pleased to spend a little bit more time with you to go through some of those questions together. So for anyone that didn't get a chance to tune into the webinar, I'll do a quick intro of myself. You can do a quick intro of yourself, and then we can jump into the questions. So welcome, everybody. My name is Destin. I am on the community team here at Jane, and my team helps organize and host all of the webinars that you have been attending for the last few years. And Alison.
Hi, and thanks for having me. I'm so excited to be here. All these questions were really thoughtful, and it just goes to show how challenging this topic is to navigate for business owners and how they're claimed. So, a sole proprietorship, that is the default. Everybody who starts a business, they start taking revenue, they start having business expenses, you're automatically a sole proprietorship, whether you register as one or not. Then, when you take the step to incorporate, that's when you would select what entity type makes the most sense for you. And if you don't know which one to select, it's a great indication that you should talk to a tax professional because there's so many nuances and it's going to change from 1 year in business to the next, depending on what your growth goals are, how much revenue you're able to earn, and of course, the rest of your tax schema if you've got other businesses. So, a sole proprietorship is a basic tax return that just gets attached to your personal tax return. So, it's like a supplementary form that gets attached to the personal tax return to indicate your business's income and your business's expenses, aka tax deductions. An S corporation is a way to take advantage of different tax structures. And the most common structure that we see in the practitioner space is an LLC formation filing as an S corporation. So, yes, there's an entity type and a filing type because everything with the IRS is complicated. That is like a high level overview of those two differences. But the key thing that I want to talk about is S corporation election allows you to take advantage of certain tax deductions in a different way. And a lot of the time we see folks be able to claim or pay less, lower their income tax liability when they are formed as an S corporation because S Corp elections, it's not just about making the election and then boom, you take advantage of the tax deductions. You actually have to do two steps. So you elect as an S Corp, and then to separate yourself from your business's overall revenue as your income tax source, you actually have to pay yourself as an employee. So when you're taxed as a sole proprietorship, which is that default one we talked about, you pay income tax on the entire taxable income that the company earns. When you're an S Corp, you're only paying income tax on the amount that you're paid as a W 2 employee. And this is a huge problem. We see tons of people come to us that made this S Corp election only to find out a year or two later that they're not even taking advantage of the deduction rate by paying themselves as an employee. And so if you're an S Corp and you don't receive a W 2 paycheck, another very good indicator that it's time to sit down with a tax professional or a bookkeeper who can walk you through these steps and make sure that you're taking advantage.
One of the next questions is about accounting for merchant fees and what is the process for that?
Yeah, absolutely. So, merchant fees is a really common missed deduction for all types of business owners. But one thing that I want to kind of I'll put it under the bracket of what tax breaks do solo practitioners commonly miss? And merchant fees is a type of adjustment that needs to be made in the books. So, a lot of people that are doing DIY bookkeeping and aren't aware of the merchant fee adjustment, they miss out on a tax break and they accidentally underreport their revenue. So, a merchant fee is something that gets taken out of the revenue you earn from a customer before that money gets deposited into your bank account. So, as an example, if you process credit cards in your practice and you charge somebody $100 for the session, but your merchant processor processes that credit card and takes $2 from the transaction, you're only going to see 98 bucks in your bank account. And a lot of business owners make the mistake of believing that's the amount of revenue that they have to report. In reality, the IRS needs to see the total amount that was taken from the customer, so all $100, and that gets reported as revenue. And then there's a second hidden transaction that didn't happen on your bank account where the merchant took their fee, that $2 that we talked about in this example. So what you actually have to do is report that whole 100 as revenue and then make an adjustment in the books that's a separate transaction and a separate line item falling under a merchant fee tax deduction. So if you don't do this properly, most people underreport their revenue and then miss out on the subsequent tax deduction. And that $2 example is one, but imagine if you're a company that processes hundreds, if not thousands of transactions every single month over the course of an entire year. That's a huge red flag to the IRS if you've been underreporting your revenue on every single transaction. I'll carry on there because merchant fees is a really common one. Another super common one in that same space is interest adjustments. And the reason that it's commonly missed is because the transaction's not actually happening on the bank account. For example, if you're making a payment towards a business line of credit, let's say, and you paid $1,000 towards it last month, some percentage of that is actually an interest payment, and then the rest is towards the principal. The principal is not a tax deductible expense. That amount just goes on the balance sheet and helps you pay down that liability. The interest that you've paid inside that transaction is a tax deduction, and a lot of people miss this. So you have to make a separate transaction, just like merchant fees, adjust for it, add a new line item on your income statement, and break that one loan repayment or line of credit repayment into two separate transactions. Then you get to recognize the interest as a tax deduction that lowers your taxable income overall. The next really common deduction that gets missed in this industry is dues that you pay to professional societies. Because if it's a society that you're paying to be a part of and it relates to your profession, whether that's for education or networking, any professional organization or business league, a trade association, a chamber of commerce, all of these are tax deductible expenses. And in many cases, you may make donations to these organizations as well. And it's important to capture all those flow of funds, as many of them can be. Tax deductions, again, depending on your entity structure. The final one, and we saw a ton of questions about this on the actual webinar on the day, so it's worth revisiting it. And I actually spoke with one of our tax advisors this morning to get absolute clarity and an example on how to describe this. Continuing education fees. So obviously, medical practitioners, people in this space are always upskilling. And so educational expenses can be tax deductible. And there's two main conditions when this is true. The first one is if your employer is requiring this education in order for you to keep your current job or rate of pay, that's a tax deduction. The second time it's tax deductible is if the education maintains or improves your skills as a medical professional. So any of that upskilling that you're doing counts. There's a separate type of education that is not tax deductible. The way that it gets described through the IRS is the cost of any courses that are taken to meet the minimum requirements of a job or things that qualify you for a new trade or a business. That's not tax deductible. And to me, that sounded too similar. So I had to go get some clarity. What they mean by this is the following. Let's say I'll use tax because that's my industry. If I'm a CPA and I suddenly want to pay to go to medical school, my fees for medical school or anything that I take for that separate industry, that's not going to be a tax deduction under my tax advisory business because it's totally unrelated. That's qualifying me for a new trade, minimum requirements to be a doctor. That's not going to be tax deductible under my current line of business. But if you're upskilling in your current industry, you absolutely can claim that as a tax deduction. And if there's a gray area, like maybe you're adventuring into a new service offering and you didn't offer it before, you're not sure if it's considered a new trade, talk to an accountant.
And then what about, I know this came up during the webinar, what about costs for things like tools and services you use? Jane, how does that fit into your tax deductions?
That is 100% tax deductible expense. And so is bench. Any professional services, whether it's legal fees, something for merchant processing, Jane, these are all tools that you need to run your business properly. Or in bench's case, you need it to do your bookkeeping and file your taxes. So the IRS knows you need tools like this. Those are 100% tax deductible and they each have their own category. So if you're not sure which category to put them in, good indicator you should come and talk to a bookkeeper.
Great. And then I know this came up in the webinar as well, but how about receipts and credit card statements? What if you just have the credit card statement for something versus the receipt? How do you go about dealing with that for your taxes?
Folks always try to get around the maintaining your receipt records question. And I'll just say this, you have a choice from here forward to collect as many receipts as possible, hang on to them, and protect yourself in the event of an audit. It's a Small step on the regular to do that saves you such a huge headache if you're ever audited down the line. Now, that doesn't mean that you're hooped if you don't have certain receipts, right? A lot of the bookkeeping work is done off of bank statements and credit card statements. But if you are audited, the more receipts you can have to back up those deduction claims, that's how we can make sure that you come out of an audit unscathed and without any of those deductions being rolled back. So you can still include tax deductions if you don't have the receipt, as long as they're true business deductions, they happened on your business account, or you included them as a personal contribution to the business on your personal account. But wherever possible, you have to save those receipts. It's not that you need to submit them with your taxes. That's what's going to guarantee your rate of deduction that you claimed. If you are flagged and the IRS is auditing you, it's very easy for them to just say, no, we can't include any of those. You didn't have receipts. We don't trust you that they're business expenses. Obviously, I'm paraphrasing how that conversation goes, but save yours. It's worth your while.
And there's just so many helpful tools now where you can just snap a picture on your phone and have it all stored for you. And so I think that we've got a lot of tools now that can really help with if, yeah, I think you'd mentioned the webinar, like the old school way of just like sticking it in a shoebox. And now we have all sorts of ways to digitize it. So I think you've got more tools at hand. So hopefully we can all get a little bit better at saving our receipts.
Totally. And banks are getting smarter too. There's a lot of really cool banks out there that have receipt capture tools. If you want a
Mm-hmm.
recommendation for one of those, you can come and talk to Bench. Or, yeah, an outsourced tool like shoebox.com. That's exactly what they are here to replace is the old shoebox method. But we do still have a lot of customers that are happy with their Dropbox method or they use Google Drive, whatever is going to be the easiest entry point for you to start snapping pictures and saving those receipts from today moving forward and have your employees do the same. That's what's going to be the best move for you.
And then thinking about saving all of your receipts and working towards filing your taxes, what about filing quarterly taxes versus waiting till the end of the year? Is there any benefit? Is there a reason to do one or the other? Is there certain scenarios where that would make more sense than one or the other?
Yeah, so there's some scenarios where you're actually required to do it that way. And if this is you and you haven't been doing it, there are late fees associated with that. So you want to make sure you know what your obligations are. As a general rule of thumb, if it's your first year in business and last year you just filed your taxes as an individual, if you owed more than $1,000, there's a good chance that the IRS is going to request that you pay your taxes quarterly. If you've never owed taxes before or you had refunds, it's your first year in business, this is not going to apply to you. So don't stress. If it's your second or more year in business and you did owe more than 1,000 in the year before, you should be filing quarterly. What quarterly taxes are, it's just an estimate on the overall amount of taxes that you're set to pay at the end of the year. And what this is from the IRS's perspective is really just them hedging their bets that you're going to maybe not be able to afford your full tax burden. So they want to collect from you throughout the year. But I actually think that this is a good way to do it because it's forced savings, right? If you have to pay your taxes more frequently, it requires you to think about how much you need to be setting aside for taxes based on your revenue and what your deductions have looked like historically or what your accountant suggests. If you're struggling to come up with a way to calculate your estimated taxes, Bench has a free online calculator. Thousands of business owners use it, whether they work with Bench or not. And it just helps them figure out based on last year's taxes, what they're projected to do this year. Here's how much you should pay on the quarter. But again, I want to reiterate, if you are a business owner that's required to file quarterly taxes, those are due, depending on your corporate structure, they're due basically at the same time as personal taxes are due. So it can feel like a double whammy, and it's just really important for you to know what you're obligated for. And if you don't make those quarterly estimates, there's potentially some fines and penalties in it for you. And that's just a dollar that should be in your business, working for you, helping you reinvest, helping you pay your employees or yourself, and not erroneously given to the IRS. So it pays to be organized, as annoying as it is to have to think about taxes 4 times a year.
So a lot of Jane's customers are practitioners, as all of them are practitioners. They work in health and wellness. And so one of the things that they do is laundry for their practices. They'll have sheets that go on their massage tables or practices, or maybe some of the uniforms or clothes that they wear, cloths, towels, things like that. And so we had a question, I believe, that came up during the webinar about what about doing laundry at home and how might you account for that on your taxes at the end of the year?
So I saw this question a bunch on the day and I wanted to go get more information about it because It's not, the reality here is, right, tax deductions come from money that gets spent in the business. There's not really a deduction for time spent doing something. So unless you're paying an employee or a contractor to do that laundry, or maybe you're spending money on a laundromat or fees associated with getting that laundry done, when that money leaves your bank account, that's when it's a tax deduction. If you're washing sheets or items directly related to the business and it's not directly a cash outflow, it's not going to be a deduction. Now, there is a case where you could substantiate a portion of the water and electric costs that are associated with doing that business laundry. You could deduct that through reimbursements if you're on an S corporation, but you'd have to be able to support those deductions with records. So the percentage that you're deducting, especially if it's laundry at home, it would have to match the same way that you're doing your home office deduction calculations. And there's just simply no deduction for washing your clothes that you wear to work. So it's a totally different story. If you have a washing machine that you purchased and it lives at your practice or in your 100% office, you're claiming 100% business use of that machine or the water and electricity associated with it, the different story. But this is one of those ones where if you know you want to like get deep in the weeds and be really creative about that deduction, do those calculations with your tax professional. And if you don't have one, bench could be a good option for you here.
All right, so let's chat a little bit more about S corps and personal expenses. For example, home office deductions or mortgage payments or things like that that maybe happen on a personal card. How does that fit into taxes for people?
It's another note to just say that doing the actual S corp election, it's not challenging to do that paperwork. What's challenging is the kind of like next stages to not only take advantage of the tax breaks under the S corp, but also make sure that you are tracking everything properly. So we've all heard about that, like piercing the corporate veil or this idea of having everything separated. That is so extremely true under S corps. And S corp deductions generally follows the cash. So let's say you've paid some expenses personally, either vehicle use or for home office. It has to be described in what's called an accountable plan and reimbursed regularly. The IRS wants it monthly, but at least quarterly. So, an accountable plan basically has you settling any of these personal expenses that you're paying monthly or quarterly with the IRS. And those expenses have to be reimbursed to you by the business itself. So you do this on a Form 1120 at the end of the year. I've got some tips that we're going to send out, like articles, but basically, if you are an S corporation and you know you have a lot of deductions that are still coming off of your personal cards, maybe you've recently made the transition or you've just never really organized it. Once you close out 2023, set aside some time for yourself to start migrating those expenses over to your business account so that you don't have to stress out about an accountable plan. If you're trying to manage an accountable plan yourself and you want to tear your hair out, you're not alone. It's hard to do, and that's exactly what a tax advisor is here for. So, just to reiterate on S corps specifically, if you still are relying on your personal credit cards a lot, it's just creating an accounting headache at the end of the year. So you can do it. And a reputable tax professional is going to be able to include all those deductions for you, do the calculations. But the best thing you can do to set yourself up for the future is to keep everything as separated as possible.
So, is there one tip or one piece of advice that you like to give people when it comes time to filing their taxes?
My number one piece of advice is really think about your skill set and what you're passionate about. If those things are not bookkeeping and taxes, then work with a professional system to do it. I think a lot of the time business owners try DIY in the beginning because it seems like a cheaper route. It seems like it's going to help them save themselves some money. But what you're missing out in terms of the expense of a bookkeeper, you're tripling pouring on in terms of time spent, stress. If you're someone that's woken up in the middle of the night with a sheen of sweat on your forehead because you're wondering if you captured your receipts yesterday or if you forgot to reconcile last week, these are real experiences that business owners have all over the United States, all over the world, really. But at the end of the day, like you started this because you're passionate about something. Probably in this industry, you want to help people, and bookkeepers and accountants want to help you. So turn around, let them handle the bulk of the work and start to look at bookkeeping and tax help as an investment in your business's growth and in your ability to pay your tax obligations on time without overpaying. My number one tip is to outsource, but if you can't do it, then you need to just get some training in the DIY software that you're
That's great. Thank you so much. I know there were a ton of other questions we would have got to, but I think these are some really great questions that we managed to talk about today. And for anyone that is watching this, we also have our community groups that you can join on Facebook, where you can chat with other practitioners and business owners about how they've handled their taxes, any sort of tips and advice they might have, as well as obviously reach out to the bench team, take advantage of their resources. Again, thank you so much, Alison. It was such a delight to have you at our webinar and here in our after session as well, providing some additional answers for our community. We really appreciate it. And we hope to do another session with you again soon.
Yeah, my pleasure. Me too. We'll see you soon.